When it comes to retirement savings plans, no tool is more popular than the Roth IRA. It's got tax-free retirement withdrawals, and it sounds just great. But here's the trick: rolling over to a Roth is not always the no-brainer that it might look like. Before you go for it, there are some absolutely critical considerations that you should have in mind. A poor timing of the conversion can cost you thousands in taxes or destroy your path to financial independence. That's why understanding the subtlety of this decision is important, especially if early retirement is part of your plan. Let's get real for a moment, though. Why would anyone want to do a Roth conversion, anyway? The appeal is with its long-term benefits. With a Roth IRA, you pay taxes on what you contribute early on, yet once you become a senior citizen, your payouts are tax-exempt. What a relief to early retirees like us. Just imagine having access to your cash without Uncle Sam getting his cut. Bliss, right? As with everything under the sun, however, all is not peachy keen here. Here's the important takeaway: timing is more important than you realize. Rolling over to a Roth tends to create a taxable event because you're taking money out of a traditional IRA or 401k, where contributions were tax-deferred. If you're having a high-income year or are close to retirement, this extra tax load might bump you into an even higher tax bracket. That's why it's so important to consider your current tax status before making the switch. Ask yourself, will I be in a lower tax bracket now or in the future, in retirement? If now, this may not be the best trade. Tax-free withdrawals are where you can withdraw your Roth IRA money without paying taxes on it, and this is a major selling point to retirees. Retirement savings include all the accounts and plans by which you save for life after work. Growth in investment is the term used to describe the way that your money piles up over time, especially in tax-deferred vehicles like a Roth IRA. Financial independence is a status where you possess enough means to live luxuriously without anticipating a paycheck. All these factors boil down to the primary consideration of whether or not a Roth conversion aligns with your goals. So, what are you searching for before converting? One obvious red flag is reducing the tax burden. When you convert, the funds that you move constitute ordinary income. If you've already got a good income stream, tacking on a big hunk onto your tax burden might send your tax bill skyrocketing. Say, for example, you're converting $50,000 out of a conventional IRA to a Roth. Depending on your bracket, that would mean owing up to $10,000 or more in taxes right off the bat. Yikes! To avoid surprises, run the numbers carefully, or better yet, consult a financial advisor who specializes in retirement planning. Another insight worth noting is the importance of your retirement timeline. If you're aiming for early retirement, liquidity becomes a priority. Converting to a Roth locks up your funds for at least 5 years, thanks to the IRS's rules, unless you're over 59 and a half. If you need access to that money sooner, you'll be penalized. On the other hand, if you know you won't touch the money until later, the long-term tax savings might be worth the upfront cost. It depends on your own situation and goals. One place where a Roth conversion is particularly good is with estate planning. If leaving a legacy for your children or grandchildren is in the works, a Roth IRA can be an effective weapon. Contrary to traditional IRAs, Roths don't need minimum distributions in your lifetime. That means the account will keep growing tax-free forever. In addition, beneficiaries who receive a Roth IRA will also have tax-free withdrawals. Just keep in mind that this strategy works best if you can pay the conversion taxes out of pocket and not draw from your retirement savings. Speaking of savings, let's talk about investment growth. One of the best things about a Roth IRA is its ability to grow exponentially. Since earnings grow tax-free, every dollar you invest has room to grow compared to taxable accounts. This compounding over time can really pile up. But here's the catch: if you convert too late in life, you may not have time to recoup the taxes you paid initially. That's why younger investors reap more from Roth conversions. They have years, or even decades, to let their investments recover and grow. A handy trick for considering a Roth conversion is to compare your current and prospective tax brackets. If you expect to be in a higher tax bracket in retirement, converting now is the better choice because you'll be taxed at today's lower rate. But if you foresee falling to a lower tax bracket later on, keeping your traditional IRA can save you in the long run. Keep in mind, though, that tax legislation is continually changing, so being aware is important. Software like tax calculators or a CPA consultation can help you do the math. You can ask now, how are you going to balance risk and reward? A Roth conversion is an act of risk management. It's a weighing of short-term expense against long-term gain. To reduce risks, space conversions over a number of years. Instead of rolling over a sum in one transaction, split it to minimize the blow to your taxable income. This can help you stay within an acceptable tax bracket while continuing to enjoy the tax-free withdrawals of a Roth IRA. In summary, let's recap the highlights. Roth IRAs and other retirement plans offer fantastic tax-free withdrawal and investment appreciation possibilities, but they are not silver bullets. Timing, tax implications, and personal goals must be the forces guiding your decision. Familiarity with terms like retirement savings, financial independence, and tax-free withdrawals will inform your decisions about what works best for your desired future. Informed, you are better able to grasp the nuances of early retirement and develop a plan tailored to you. The key takeaways are that you must watch out for timing your Roth conversion, be aware of how taxes influence your retirement money, and utilize investment growth for long-term success. Estate planning and financial independence also come into play when ensuring a Roth IRA is included in your entire retirement plan. With these resources, you can create a plan that keeps as much of your wealth as possible and does not waste money unnecessarily. Ultimately, keep in mind that there is no one way to ensure success. Each person's path to retirement is unique, and what is right for one may not be right for another. What is most important is taking the time to learn, ask questions, and get professional guidance when necessary. Go into your retirement planning with curiosity and purpose, and don't make hasty decisions that can impact your financial future. And remember, the objective isn't merely to retire, it's to retire well.